Get started. Okay, my name is Pablo Ortiz. You may know me already from FX Street or from some other media. And we're going to be lecturing today about risk management, second part. We talked yesterday about risk per maximal drawdown, how much we can have in the deepest valley in our trading account. And today we'll be talking about a position and trade management and exactly what's the maximal risk, the average risk I can really expect in those. And it's very important because we got always told and so on, and we will have a look into it, and it's not going to be a very good definition actually what we got before. Okay, we need first to distinguish between a trading position and a trade, and it's not the same. A position can be formed by a single trade or more. It can be conformed by trades in the same direction or opposite direction. I can have, for example, a position made up long trades on the euro dollar and 2 short trades on the euro dollar. And that would be a position as well. If I'm trading all those 5 trades together, it would be a position. If they have a sense together, this is for later. Here, there, a test, we're going to use it later. Let's take, for example, here, for instance, I would be here selling, no? Like I could make a sale here. I think you see my mouse, right? And I could make another sell here. These two together would make a position composed of 2 trades. Okay? And we will check why we would be doing this, actually. No? So a position based on re-entries has to have a reason. I just don't make a position based on more trades just because I feel like. There must be a logical reason to it. And that's very, very important, okay, that you have a reason for a position taking place, actually, based on more than one trade. When we have a position that, actually, the reasons are the following. It could be I'm losing, and I want to hedge my losses. For example, I would be here making a sell. Well, that would be a winning trade. Let's make a buy here. It's completely crazy, but whatever. Let's make a buy. And here I make a sell. Short position. Here I make a long position. I make a long position here. I would be hedging this loss. That would be freezed. Normally, when you hedge in losses, you're freezing the losses. And when you hedge in earnings, you're freezing the earnings. How does it work? Let's say, for example, I'm here making a buy trade. I'll put it in blue. Not very clear, though. Then you get a fresh screen for you guys. Probably black and white is better. Let's see. Okay, here we go. So let's say, for example, you'd be making here on this pullback. You see this? Like it formed, first pullback, second pullback. I'll be making here a buy trade. By trade, not position. People use it indistinctively, and that's a mistake. I'll make it blue. Blue is for long. And I have here a buy, okay? And let's say, for instance, I'm here, and it's already here. It's pretty much not taking direction, and say, you know what? I don't want to close the trade, but I want to freeze my earnings. So I can make here a sell of the same lot size or smaller lot size. And that hedge would be to freeze my earnings. Do you see that? Instead of closing, I can freeze my earnings. I just lose only the spread. So I can do it for different reasons. I can have positions while I'm losing. I can have positions while winning to freeze the earnings. I can promediate. What is promediate? Actually, let's say, for instance, like the opposite example. Like, let's say, for instance, you have I'm going to delete this one. It's a new example, okay? Let's say you would be buying here, expecting the pullback is finished. You should be buying here. You expect that it was a good moment to buy, but it wasn't. In the very moment, it wasn't. It can be later on a good point of entry. And you'd buy again here and put it blue again. That's not hedging, that's promediating, okay? And instead of having to have the exit, let's say, for example, it would be this would be my original take profit. I'm going to put it green. Instead of having to go out here, I can go out much earlier in these two positions. I can promediate. For instance, I can go out something like this. You see that? Because if I have the same lot size, here I'm already in earnings. You know, that's promediating. So that would be a reason to have a position. Another one is adding to the position. You do that already in earnings. Let's say, for example, new example, right? Let's say by here and the line on the top, right? You're already in earnings. So you buy here on this pullback, right? Here. That's adding to the position. That's a reason to have a position out of the trades, right? So you are quite certain it will continue up, right? And you do this to add to the position. Understand hedging. We're trying to understand MRC. We're trying to understand that a position is not a trade, period. And I'm just giving you all possibilities why you would make more than one trade for a position. Just so you know that this exists, not that we are going to hedge, nothing of the sort. I don't hedge at all, okay? Okay, so now that we understand that a position is not the same as a trade, we need to understand the next definition. What is an atomic system? An atomic system is a system, I call it Asterix. I don't know if you guys read these cartoons. It was part of my childhood. I think all Europeans read Asterix and Obelix. Who in this room read Asterix and Obelix? Somebody knows this cartoon? Great. Okay, so there was these two guys, they were fighting against the Romans, right? And there was Asterix, this is this guy, and there's a movie actually with this Gerard Depardieu with the actor. Well, and Asterix, they had a special beverage that it was very magical, it gave him a lot of strength. But Asterix only could be strong when he drank it. And the other guy, as a child, fell down in this drink, and he was very strong, you know, by default. Okay, I'm showing you my age. Yes, it doesn't matter, Paul. Whatever, we are young still. So the point here is that Asterix was fighting the Romans one by one. He was fighting the Romans one after the other. Okay, so that's very important as a concept. I only trade Asterix systems. They are also called in the literature, the professional literature, atomic systems. That means one trade equals one position. That means I enter the market, I buy or sell, I lose or win, period. You say, wow, that's very fundamentalist. Yeah, it is. But you know what? I have a lot of those systems. I have a lot of Asterix systems. You know what the opposite is? The opposite is this. The opposite is Obelix. You know, the guy, that's position management, Obelix style, you know? You go and you fight 10 Romans at the same time. It's great if you're Obelix, you know, you have special powers, you know, but that's not so great for consistent trading, you know? You know what happens when you trade like this? You end up like the coyote, you know? You have this phase. After you make a position of 10 trades, 15 trades, you know, and you don't know how to exit. So my recommendation is just trade Asterix systems, just trade by trade, one trade equals one position, period. It will help you a lot, you know. You will, if you cannot be consistent with Asterix systems, just trading one trade per position, you will never be able to trade 5 trades per position. You see that? So let's start simple. It's more controllable. It's easier to calculate the risk. It's more consistent over the long term, and it allows you to combine, or me to combine, a lot of trading systems, you know, because I'm trading Asterix. You see, I don't have the hassle to check, wow, you know, I have to put another trade here to recover this position. Okay. So once we understand this, we can easily calculate our, you know, you know that one trade position, right? So you heard this depending on which 2% we are talking about. So we said yesterday, in the video, whoever was not here yesterday, I strongly recommend you that you watch it in our YouTube channel. That's 23% of your maximal drawdown. You should never go beyond, in one trading system, beyond 23%. If you have 2-3 trading system, we will allow 30% drawdown. But that's it. You will never go beyond 30%, 23%. So let's suppose we are Superman and we're risking just 4% per trade. That would mean that with 6 trades, we would be already arriving at our maximal limit of 23%. You see that? And believe me, 6 losing trades are very easy to get. You don't even need to have them consecutively. You can have 3 losing trades, right? You can have 1 losing trade, another losing trade. That's the capital curve. Another losing trade, 1 little earning trade, right? 1 losing trade, another losing trade, 1 earning trade, very little one. Sorry for the gaining, and 1 losing trade. That's 6 losing trades. At 4%, you're already at 23%. Right? Or 22% if you make here 0.5 and 0.5. So that's very easy to achieve. And that's very bad. So you can never, ever risk on average 4%. You can neither risk 3% because 3% is just 8 trades. That's only the mathematical combinations. You know, I mean, if you calculate the probabilities of having 8 losing trades in a streak, but you don't need it to be in a streak. Just say twice 4 losing trades. That's very easy. I bet in a 3-month period you will reach 24% very easily if you're risking 3% on average. If you're risking 2% of average, you only need 11 trades. So that's false also. I mean, you cannot, you can very easily have 11 losing trades. Just take 3 losses 4 times, right? That's 11 trades. That's 12 trades. So you cannot risk 2% on average. What is the figure? It starts below 1%. You shouldn't risk more than 1% on average of your capital. Because 23 trades, it's a lot of trades, and it's much more complicated to get 23 losing trades than 11. You see that? They lied to us. It's not true that 2% should be risked on average. What they meant is something different, actually, with this sentence. You heard it all, right? Don't lose. But the truth is, you shouldn't risk more than 1% per position, or per trade in this case, right? Is the concept clear? Imagine you're trading really like an institutional trader. You wouldn't be risking more than 0.5. That means it's almost impossible you'll ever reach the 23% mark, right? Because you would need 46 trades. Believe me, I mean, something very bad should be happening if you have 46 losing trades, even if it's not consecutively. Do you follow? Guys, everything clear? Great. What about the other guys? No, Linda? Okay, Linda, ask what was not clear. Basically, we're calculating on the figure of 23%, which there is a video that explained it yesterday, how many trades we should be, depending on the trades that are losing, what is comfortable or what is feasible to lose. And my calculation says it's 1%, because 23 losing trades is very, very difficult to happen. Is it more clear now? It's all based on reaching the 23% mark. But if you were not here yesterday, there's a video. You can watch it later at home. It's already uploaded, right? FX Street. That clear? So don't risk more than 1% per position. That more clear, Linda? Okay. We need to define the next thing. It's very important. Yeah. I will explain it over the slides, Linda. Anyway, the video is recorded and you can go over it again. Yeah, it's a very important subject. Actually, these 3 sessions, by the way, I cancel the session tomorrow. I cannot come. I'm sorry, guys. It will be postponed for probably next week. The crucial thing about trading. I mean, the safety nets, risk management, there is nothing more important than this. Okay, so we need to understand what is a fork system. A fork system is a quite idiotic system where you just trade and you enter the trade. Let me show you a picture of that. Listen, I have the slides by mistake in Spanish. That's a fork system. A fork system is basically I have an entry point, and it's just go out by take profit, the green line here, and by stop loss. You see the fork? You see the fork? Just forget about this line and forget about this one. Just see these three lines here. Entry point. In this case, I have a system which is the ratio 1-to-1. Thanks, Adina, for putting the video for Linda here. And in this system, I either win one or lose one. That's a fork system. You see the fork, guys? It's not very difficult to imagine a fork here, right? Do you see the fork, guys, or not? I call this a fork system. Yeah. So fork system is a silly system. Majority of manual traders, they trade silly systems. They trade like forks, you know, and it's not very good. It's not very good because we will improve the system now. Imagine we would be so smart, we would put additional exit rules. Instead of touching the stop loss, we would be exiting earlier. Where? Here. Do you see this orange line? We managed to reduce the losses. How? With additional routines. We say, listen, you are trading scalping, you are 5 hours in the market, take 12 pips loss, for example, and your stop loss is 50, right? This would improve your losses, right? And imagine we exit also earlier in the take profit for whatever reason. And see here, now the ratio is 2-to-1. The distance from the entry to this green line is twice the distance from this entry to the stop loss. So that's an improved fork system. You follow? So what does it mean? Basically, it means that the maximal risk and the average risk, they should be different. If you're a very good trader, you manage to exit before the stop losses and before they take profits, and to improve your ratios between both exits, right? The winning exits and the losing exits. So it's very, very important that we start distinguishing between average risk and maximal risk. Okay, and if we take MetaTrader, let's do it here, and we have here the strategy tester. Here I have an account here in this broker. I make here view, strategy tester. I have here a robot, right? And I just made a back test over a very long period of time. I made a back test from 2002, January till 2015. 7th of May, whatever. I could do it till today, but it doesn't matter, right? And it's a lot of years. It's 13 years, 14 years, something of the sort, right? And what is very interesting about this back test is the following. Let me move this here. Sorry, guys. Now you see it better, right? So we have a very important point here. The largest losing trade is 2.62% of my account, because I always do my back test with $10,000. How often I back test? All day long, Paul. We are back testing 8 hours per day. We are professional automated traders. We are back testing all day long. What's the question? How often I optimize a robot? If the robot is good, once a year. If the robot is not so good, every 6 months. So basically here, the maximal risk is 2.62%, right? But the average risk, do you see this other line? Is much less. I'm risking only 0.61%. You see that? I have trades that lose 2.62%. We can go here in the back test, right? We can order here by profits. You see that? I have a losing trade on the 5th of January of 2015, where I lost 2.62%. I have another losing trade here on the 9th of December 2011, where I lost 2%, right? But they are not the same losses, you see, because I have intelligent exit rules. I'm not losing every time 200, you know, and the average is much less than 1%. You see that? That's the point. The average risk is 0.6%. The maximal risk is 2.6%. You see the difference, right? Why? Because I improved my fork. You follow now? And that's what you need to do every time you're doing a good trading system. You need to improve, and you need to make the average risk per trade much lower than the maximal risk. Why? Because you will be exiting very often before your stop loss. You see? That's the whole game, guys, in risk management. Don't go to your stop losses. Exit a majority of times much earlier. And then this figure will be different to this figure. You know what they told you, 2%? They meant maximal risk per trade or per position. When they said don't risk more than 2%, even I risk even here a bit more than 2%. You see that? 2.6%. But to tell you the truth, over 15 years, how often I'm over 2%? I'm only 1, 2, 3, 4, 5 trades above 2%. You see that? Right after, I'm below 2%. So if you say, okay, 5 trades over 15 years, I lost a bit more than 2%, it doesn't matter. As long as it's not 3%, as we saw, right? But on average, I'll be losing only 0.6%. That's $60. $60 on a $10,000 account, that's nothing. You follow? I'm losing nothing here on average. So is it clear for you guys the difference between average risk and maximal risk? Did you follow on that? Is it 100% clear? Great. So now we understand how to improve the systems. We need to add additional intelligent exit rules, like here in the slide. We need to find additional intelligent exit rules. That will make me a much better trader. And as a maximal risk, I can risk 2%. We'll see it. And what happens? That our edge improves majorly, right? What is the edge? The statistical percentage that they have of probability of having more earnings than losses, right? So what's the point here? The point of the conclusion is that an average risk of 1% is reasonable, and a maximal risk of 2.3% is acceptable. But they should be different. An average risk of 2% is fully unacceptable because it's very easy to have 11 losing trades. You can never risk on average 2%. That's wrong. You lose your accounts like this. You lose one account after the other because once you hit the 23% valley, 23% maximal drawdown, you will never recover from that point. Okay. Ideally, we should be trading less than 1% on average. And there is a very remarkable difference between trading 0.8% average risk compared to, for example, 1% or even 0.5%, right? You see that? This trading system is fantastic. As a matter of fact, we give it out for free when we go to lectures, you know. But the point here is, on average, I will be losing only $60, which is 0.6%. Even if sometimes I lose 2%, right? That's very, very important because it's crucial that, and that's what we call safety net number one. The safety net number one is largest losing trade. You see it here, an average losing trade, and the figures here should be different. When you have a trading system which is a fork system and you make a back test, you will have this figure very similar to this one, almost the same. Why? Because maybe there is a Sunday gap and it didn't respect your stop loss, right? But the figures will be very approximate to each other. Here, we have almost 3 times less on the average risk, 0.6% to 2.6%. It's almost 4 times, over 4 times more risk on the maximum than on the average. You follow? We managed to reduce by 300% the risk on average. How? We don't wait for the stop loss. That's idiotic. That's moronic. You have to have a stop loss, but you don't wait for the stop loss to happen. You exit earlier. And because we do robots, we exit much earlier. And these rules, from exit rules, of course, I have it all automated, Paul. It's all automated. We are automated traders. We are only just starting in English these lectures with FX Trade. We've been for years in Spanish and Italian. And what the point is, we're starting from scratch now in English language to explain all our method. But we are algo traders. We do only robots. You can apply it to manual trading, of course. You should. But it's better if you test these exit rules, right? Why would you go before the stop loss? What is a good idea to go out? Is it an RSI? What gives you the signal to go earlier? Okay? To close the trade in losses, but not stop loss. Okay, so now that we understand that we reduce the average risk per position, of course we will have less earnings in the account. If I tell you the maximum you can afford to risk is 1% on average, of course your earnings will be lower. But you can also think it can be dynamical. Let's say, for example, if your system is doing very fine, imagine you are trading and you're exactly caught, I don't know, this moment, right? It's just going up the curve. You could be risking 1.2%, for example, or 1.3% on average. And when you're here in this period when it's not really earning nor losing, you could reduce your risk down from 1% to 0.8. You follow? You don't need to have always the same risk. I don't understand the question, Linda. If I exit 1%, joining the other side? No, I don't hedge. I just take my loss and I go cry to the corner. You know? I don't take the $200 loss. I just lose $100. I admit the loss. Sorry, I made a joke out of it, but I just accept my losses. You follow? I don't continue trading. It was a wrong entry, period. It's very important. I just wait for another signal. What triggers the exit in the early? A lot of things, Paul. There is videos. You were attending these webinars. I recommend you highly, Paul, to watch the webinars that we did about trading systems last month. You remember them, Paul? Especially the one about scalping. I can if Adina has the link here, you can put it here, Adina. But basically there I give some exit rules. Would be the best that you watch it again. You know, there is a lot of ideas that you can have, and that there's the juice. You're making exactly the question. There's the juice. How to exit earlier. Okay, if you understood this, guys, I'm gonna make it even more complicated now. Shall I follow? Shall I continue? Is this clear? Great. Happy we got you back, Linda. It's great. Okay, so we didn't discuss another thing. How is the distribution of the trades? And you know what? MetaTrader doesn't tell you. We have a software. We have our own software. That's a screenshot of our software. It's not on sale. We will sell it someday. I'm telling this for over 2 years. You know, the programmers. I travel a lot. I've been all over the planet. I've been to Hong Kong. I've been to Cyprus, Italy, whatever you name it. Now I'm going to London, and we never finish the software. But someday it's going to be on sale. Okay, we just take the statement of MetaTrader. Let's say, for instance, this statement. You saw that. And now we want to know in the losses and in the earnings, trade by trade, how does the curve look? And it looks like this. It tells us the minutes that the trades were in the market. You see here, this trade was 1,000 minutes in the market. This trade was 250 minutes in the market. 250 minutes is like 4 hours, right? That's a scalping system, you see. And we see the longer in the market, you see, the more it loses. Do you see it, right? That's typically scalping, right? At the beginning, a lot of earning trades. You see that? The longer we are in the market, the more it goes below zero. You see, and that's in percentage, actually. That's actually 0.25%. 100 is $100. It's not in percentage. It's wrongly written here. It's in dollars, right? And the question here is, what's the average? The average is here, the orange line. So you see the maximal risk, there was one trade, I lost 2.5%. There was one trade, I lost 2.25%. There was one trade, I lost 2%. The maximal risk is 2.4%. You see that here, this trade? But the average risk is 0.25%. That's excellent. Because this scalping system will exit before it touches the stop loss, which is here. You follow? So that's the whole game we are playing here. And in this distribution, it's not a very good distribution, but because what we are looking actually is that we have a Gauss bell. Let me show you. You see here the Gauss bell in green. Imagine it's upside down. And that's the losses below zero. Maximal loss 3%. That's another system. You follow that. Do you see the Gauss bell here? Do you know what a Gauss bell is, guys? Gauss distribution. Gauss bell. Does it sound familiar? Yes or no? Gauss bell. Did you see this before? Okay, great. let's say, for instance, you are doing an IQ test, right? The average will be 100. If you have 100, you are not smart, you're not silly. You're just plainly even. You're just average, right? And if you're very smart, you will have 120, right? And if you are, or if somebody else is quite silly, they will have 80, right? And that's a distribution. Majority of the population will have average IQ. Some people will have 120, and some people will have much more than 120. And we distribute that. That's a Gauss Bell. You see, that's a distribution which is statistically Gaussian, it's called. It's a mathematician, I think he was from Switzerland. And that's called a Gauss distribution. Please just check it out in Wikipedia, right? So the ideal is that we have the losses distributed like a Gauss bell, which happens in this system. You see it here. The average is 1%. You see it? Average is 1%, the orange line. Maximum is 3%. And it's like a clock. It's like a bell. Do you see it now? So that's the ideal if you would have this kind of distribution, but it doesn't happen very frequently. So you need to analyze in your trading system also how you distribute that. And you can export it from MyFX book, or you can export your statement from MetaTrader. And with Excel, you could analyze these things, right? You could analyze what is the distribution of my losing trades. And it's very important that you know that, because the closer it is to a Gaussian bell, the more stable is the losses. You know what to expect. So what happened with the first system? It was not a fork system. You see it, the first system. You know what happened? You see the exit points here. They seem quite chaotic. The same, the losses here, right? Seems quite chaotic. You know why? Because it has dynamic exits. It doesn't have fixed stop loss. It doesn't have fixed take profit. It's just based on a formula, right? For example, if you make a system which will go as a percentage of volatility, let's take here, for example, the ATR indicator. I don't know if that's too difficult now, but if you get lost, just tell me. That's just an indicator of volatility, okay? And it's the average true range. It tells me in pips, in the last 6 candles, for example, how much was that's an hour chart, right? On the cable, right? And it would tell me, for example, here, there was a lot of volatility. It's a peak in volatility. And on average, I had 45 pips. You see that? 0.0045. So I had, on average, every hour, the price was moving 45 pips. Whereas in the night, on average, it was moving only 12 pips. It's the Asian session. Markets are sleeping. Well, not in Asia, but America and Europe are sleeping, right? So I could put the stop loss here twice the ATR, right? If I have a stop loss here, it would be 24 pips stop loss, right? If I put a stop loss in the morning, it would be 90 points, right? You follow? That's a dynamic stop loss. So that's the first system you saw. If you watch the distribution, just watch the picture, you know immediately this is a dynamic exit system, right? And you watch the other picture, that's part of our education actually. All of this, we have a course where we teach all of this. So you will be an incredible analyst. You will see the system, the trading system. You can even watch how other people trade and you know immediately if it's crap or if it's good because you know all your statistics code, right? For instance, here you see it's also a dynamic exit system, you know, because if it would be a fork system, you would have here a line and here a line. Do you follow? There would be a maximal earning, maximal take profit, and there would be a maximal stop loss. So by watching this picture, you can guess backwards what the system is doing, right? Whether it's exiting dynamically or not. Do you follow that? The fork would have here, it would be like, let me draw it to you. I mean, if you had a fork system, I didn't charge it to our software, but you would have something like this on the TP, a lot of points. Okay, let me do it again. For example, if you saw this picture of the distribution of trades, you would have a lot of trades around here. Some trade a bit more because there is a slippage in the broker, right? And here would be written, for example, on average, $300. I earned $300. And you would have here, this would be the 0.3 And this would be the losses, and you would have here minus 200, which is equivalent to 2%, right, on $10,000. And you would be having a lot of points here, right? Here is one which is a gap. Here's the situation of the Swiss franc. This guy, this outlier, you see? That would be the distribution, and you would see immediately the fork. Do you see it? So it's very important how is the distribution as well. So when we are talking about safety net number one, I'm going to recap. First of all, you need to distinguish between average risk and maximal risk, right? And you need to know that average risk is not equal to maximal risk. Before that, you need to trade systems which have only one trade per position. That means forget about obelisks, right? We will not trade any more obelisk systems. It's finished, okay? Obelix is done. We trade only asterisk systems. That means we trade only once per instrument. That means if we are making euro dollar, we put our long trade, that's it. We don't put any more trades till it loses or wins. You follow that, right? And the last thing, we need to watch the distribution. We need to watch how is the distribution if we don't have a fork system. If we improve this fork system, how is the curve? Is it similar to a Gaussian curve or not? Okay. So how are we doing, guys? Some questions? We have our channel in YouTube, all about expert advisors. Fork is better? Not in risk terms, Linda. Not in risk terms. You need to put a stop loss on a TP. It's better to understand. I understand. But once you trade more, you will love the other more developed systems. I optimize at least over 7 years, Paul. 7 years historical data. I would say beginning 2007, that's the minimum. It's a lot of years. Okay. We'll be coming to London. Who is here from London? London area. Most probably, we will know next week. We'll be, most surely, it's almost 95% sure we'll be there. It's a free course. It's in the center of London. If you want to assist or attend, just send us an email with your data. What I mean by dynamic, Wojki, that the exit is based on a formula, that it's not the same. As in the example I gave you, for example, if I have a stop loss, which is twice the ATR, 2 ATR, here, the stop loss would be at 92 pips. You see the ATR is 47 pips, twice 92 pips. And here, I would put the stop loss at 24 pips. It's around, we make a discount, it's around 4,000 pounds with a big discount, probably 500 pounds discount in order to come to our trading room in Madrid. It's 5 full days and 60 hours. It's very heavy, and the hotel here is very, I mean, with 40 pounds, you get a great hotel in Madrid, 40, 50 pounds. We help you with everything. Because we have the trading room already in Madrid with 15 computers, with a beautiful terrace. It's all, and we are more concentrated. It's just 5 days and then 6 months tutorial. Okay, but we have brochures. If you want information, just write to Olga, to the email, and you'll get a brochure about our education. Okay, just come first to all the webinars. It's for free. Get all the free education we do, study it, you know, and then you're more than welcome to come to Madrid. There's already pre-registered people for the paid course. And then we'll have 6 months online with you with the robots. We'll give you free robots as well. If you open an account with a broker, you'll get 2 free robots. And we'll trade with them, and they're quite good. Actually, the robot I showed you is two robots in one. And we can have a look just to finish the webinar. I still have 3 minutes. The robot is based on, it's one scalper and one trend system. And I put them together. You have tried to get an EA written. I transfer it slowly. Well, it depends on your programmers. We can help you with that. I mean, if they coded it in a very clumsy way, of course it will not be, I don't know why it's suddenly historicals, it happens. It all depends on the coders. If they did a shitty job, of course it runs slowly. It may depend. You put too many rules. It can be also you are trading it tick by tick. My recommendation is that you trade only open price. You trade candle by candle. Oh yeah, that one goes slow, Paul. That's true. Make the robots of the other strategies, Paul. How much did it cost you? Just like, I'm curious. How much did they charge you for this robot? The one based on scalping. I mean, I don't know if Adina, you can find it here, or I'm gonna try to find here if I can find in FX Street very quickly the webinars we already lectured on. But yeah, he's talking about my scalping system. $40, that's a good price. Very good price. What do you code it with? Somebody in Ukraine or East Europe? It's fair price. Russia, yeah. You did great. Yeah, there is no other choice because this system is a scalper and you need to trade it on tick data. But you can do the other system on open bars, right? I'm trying to find my profile here. Well, it's gone. And just to show you, if you can help me, Adinda, just to put here the links yeah, he did already. It's here already, the links, right? And just have a look at the trading system lab, it's called, guys. And okay, and it would be great, really, because that will give you an idea of make the breakout system. Paul, code the breakout system. $40 is a great price. Great price. You can do a lot with that. Okay, guys. If you have no more questions, I hope to see you in London. Who else is around London area? Which countries you're living in? It would be interesting to know, guys, where you're from. Where are you located? There's a lot of Spanish speakers here. Carlos, Fernando, Hungary, it's not far. You can come to London. Ryanair. Which part of Africa? South Africa, Boyki? Yeah, we'll meet for sure, Paul. Boyki, which part? South Africa? 35, that's nothing. You know where Moorgate is, right? It's a very central location, very beautiful place. I send you the ticket. No, I may come someday to South Africa to lecture. That's why I asked. I send no tickets over. I know. Okay, guys, the rest, where are you from? Linda, where are you from? I'm curious here. Hungary is a great place. I've been there in Balaton Sea. Swimming in the Balaton Sea. USA, which part of USA? I used to live in Miami, Florida. Did my master's there. Okay, guys, we meet next week. We'll be talking California. Wow, that's a bit far away, but still, you can do it. Really, I mean, our method is very concrete. It's no bullshit. We really give you from A to C, really how to trade with robots. Even if you don't know anything about coding, you need to learn coding. I don't code. I'm a mathematician, you see. I have people to code. You find people online, they can code for you for $40. Don't spend your time in coding. Spend your time in thinking. You need to develop your brains, you see, and you need to become a trading analyst. No, trading system analyst, which is a different story. I will explain you about my view on trading. I call it the trader's pyramid. And basically, I think a trader becomes really a trader when he becomes a trading system analyst, which is not a technical analyst. People confuse these two terms. They think technical analysis will bring you further, and it's not true. Majority of traders, they do technical analysis and they lose their accounts. 95% of the people in the first 3 years lose their full account. 90%. I don't care. It's a very high percentage. And that's because they do only technical analysis. You need to learn statistics. And you need to start with trading systems. What he did, Paul, excellent. He saw a system online. He coded it. I mean, not he. Somebody coded it for him, $40. Come on, $40 you spend in a lunch, right? 2 people, even 1 person, right? Depending where you go, right? For sure, in California, you spend it in one breakfast. I don't know, right? So you really need to start coding trading systems. So watch my trading system lab lectures. Start coding those 4 systems. Don't start with a scalper because it's very difficult to optimize. That's true. And go ahead and try it. Okay. So I hope to see you around. You can subscribe to our channel as well, all about expert advisors. It's in English. And I hope to see you around next week. We'll be continuing to lecture till we meet in London. If there's no more questions, I hope you understood the difference between average risk, and maximal risk. And you understood the difference between position and trade. And I'm happy with that.